Okay, so today we have Martin Werner with us. Martin is a co-founder at Confio, and Confio basically created Cosm Wasm. Cosm Wasm is a very important part of the Cosmos ecosystem, and they are launching Tgrade now. So Tgrade is a project that I'm very excited about, and we actually, Nacion Crypto, we're actually running a node for Tgrade from the first testnet. So Martin, welcome to the channel, and thank you for being here.
Yeah, thank you very much for having me. I'm very excited to be here, and I'm always excited to talk about the project and what we've been doing and where we're going. And so
great.
Good to be here.
Yes. Okay, Martin. First things first. Tell us a little bit about your personal experience and how you became involved with crypto and maybe like blockchain and Confio.
Okay, many years ago, and I'm giving away my age here. I began life as a analyst programmer in an investment bank, Morgan Stanley, writing mainframe code. That was back in the 80s. So you can imagine what life was like then. You had green screens and green writing, and we were coding this horrible stuff that worked with tape drives and all that kind of stuff. I then spent a few years there with the bank. I moved from front office, back office, private banking, and I ended up on trading floors, writing software for convertible bonds, covered warrants, ADRs, GDRs, and basically it was really seat of the pants stuff, really exciting. We were in that era, we were all in our 20s, coding stuff that was coming from paper onto computers. So it was a great start to life. So that's how I got into the world of finance. And then I did more or less a 30-year career there. I changed banks. I had my own company. We were writing software for banks, being in that space, doing more and more complicated instruments like equity swaps, stock lending. We did some fun work with some hedge funds, some international banks. So it was great fun. But then I got to a point where I thought, well, I've done a lot of this. I need a change. And so when I was running my own business for a while, I handed over to the guys that worked for me and thought, okay, my next challenge, let's see if I can be employed again. So this is really funny. Like after 15, 16 years of running my own business, everyone laughed and said, no one's ever going to employ you again because running your own business, right? So I did it. I did a year. And during that time, it was 2017. And I was going to a lot of meetups to figure out, what's AI all about? What's blockchain all about? What's fintech all about? And I sat through a lot of bullshit in 2017 of these guys pitching up, talking utter rubbish about how blockchain was going to solve world poverty, solve the water crisis, who knows what. Anyway, what got me interested was the possibility of what it had to change how we do things with these cutting out the intermediaries. I thought this is a really big opportunity to replumb the traditional market. So obviously I'd spent all this time in enterprise banking, knowing about the flows of information, how inefficient it was, how many intermediaries there were. But also, I'd seen a lot of how banking worked well, how banking didn't work well. So all through the crises and watching what these things did and, puzzling moments. Like I remember sitting in a conference many years ago, listening to all these quant guys talking about these great things called credit default obligations and credit default swaps, and thinking, yeah, this is clever maths, but you're looking at normal distributions and those don't really work. But what am I? I'm not an academic. So it's interesting as well, having understood how you have to pay attention to risks as well as opportunities. So that was all my background. And then from that, I thought, right, okay, let's have a go at this blockchain thing. So I jumped in and started working at different companies, had a go at starting things. They didn't work. Some did, some didn't. And
was that in the 2017, right?
So 2018 is when I really started the process. I worked 3-4 months on my own trying to start something with completely underfunded and thought, no, this is too big, and stopped. Then I went to another project. They didn't get funding either, but I learned again. They were trying to do something interesting around tokenizing the return of portfolios from a hedge fund. Great concept. Didn't get the funding, unfortunately. And then I went to work at IOV, which is now Starname, which is where I met Ethan and Simon. And we worked together. We had a great time. And one thing led to another. We ended up leaving, but we all stayed in contact. So we were doing things in evenings and weekends, having discussions about, is proof of stake the best thing to do, or can we improve it? So we had long discussions about that, and we came up with proof of engagement eventually. And we had long discussions about whether a DAO works completely with code is law, or whether you need social interaction. So do you need human judgment in the forming of rules and the maintenance of a DAO? And we thought yes, and that's how we came up with the concept, what we called a decentralized social organization, which then ended up being a core part of what we did in Tgrade with the trusted circles. So then we were keeping all these ideas bouncing around. I then went to work for a crypto asset company. It was like a startup. Well, in fact, it was a spin out from a corporation, and we were doing digital custody for sort of financial institutions who wanted to hang on to their Bitcoin and Ethereum, and it was these horribly complex HSMs with backups and security, and it was fun for a while. But this itch was to start something ourselves, and Simon, Ethan, and I got together in 2020 and thought, okay, let's go for this. And we formed Confio and started the journey to Tgrade. So that's really the history of where things have come about.
That's very interesting. Such a impressive background. Very
Thank you.
impressive. Yeah. Thank you for being here again. Okay. Now I have a very easy question for you. And this is like, why, before we talk about what is Tgrade, let's say, why is Tgrade important?
So I think the really important thing about Tgrade is the focus on bringing regulated institutions onto blockchain. So it's a numbers game. When you look at what we've got in if you look at DeFi Pulse, it's what, 9.6 billion, something like that for DeFi. Okay, contrast that with BlackRock, one asset manager with 10 trillion under management. The size of these markets are huge. We all kid ourselves that, hey, a billion here, a billion there isn't exciting, or crypto's nearly 2 trillion. It's tiny.
Yeah.
And what's really stopping this institutional move onto blockchain and using this technology and cutting out the intermediaries and bringing the transactions closer to the originators, to the investors, is this whole jungle of pseudonymous, very powerful. But if you're regulated by, by regulation the jurisdiction you live in, operate in, you can't answer the question, where those funds coming from? Oh, it's from a liquidity pool. Okay, so who's put the money into liquidity pool? I don't know. It could be a really nice guy down the road, or it could be a really horrible man down the road. We don't know. So that to them is a big problem. So what we try to do, our thinking behind it all is we really value the whole decentralized side of it. That's really important. It's, I think Nassim Taleb coined it very nicely when he came up with the concept of anti-fragile. So what benefits by being the opposite to fragile? So I think decentralized networks, like nodes running all over the globe, different countries, different sized companies, that is so much more resilient than one company managing a network. And then you have all the other parts of blockchain on top of that. So that makes it really strong foundation. And then from that, you have this public network. Don't worry about it. It runs itself. It has an economy. It has a life cycle of itself. And then on top of that, if you start then building permissions on a self-sovereign way, that gives you the power to say, okay, in my country, these things are important because the regulator will beat me up if I don't have this right. I'm going to form my own rules to comply and to match the regulations. And I'm going to set up the rules for those people who I care about, my customers, my counterparts in my jurisdiction. And so if you can do that on a blockchain, you're already solving many of the problems. And that's where we came up with the concepts of the self-sovereign governance, that you create all the rules, the frameworks to match your legislation, and then you match the identity to a blockchain address. Bang, you've got a whitelist you can work with. And you go back to regulators and say, okay, we know who these people are. We've checked them. This is who they are. If they misbehave, say if address XYZ is colluding with ABC to do some front running, we know who they are. We can say, so look guys, stop, or you get kicked out. In the pseudonymous world of MEV, of rug pulls, These
The
addresses
Wild
come and
West.
go.
Mm-hmm.
Yeah. You can't persuade regular investors really to put much money in of any significance.
There's no way. There's no way. They're actually just like getting started with Bitcoin, and you can tell them to come and try, for example, one of these protocols in Ethereum, like Aave, or let's try Uniswap. They're not going to do that at all. Okay, so to my understanding, you guys are creating a the base layer, the layer for other applications to build on top, and these applications can create circles or like groups. You call them trusted circles.
Correct. Yeah.
And they will apply the KYC. They will apply the AML. Tgrade will not do that part.
No, it was a very, very conscious design decision. So every single regulated institution right around the world has a very robust compliance organization. They have already invested in people, processes, software. They do that already. All we're asking them to do is say, take your identity, Alex. I know what that is. Match it to a blockchain address, and that's it. We record that in governance on the chain. That's all they need to do. The rest of it's off chain.
Which makes it easier for you. It's like on your end, you don't have to deal with all that off-chain information to on-chain information. I think that's a great point. Okay, so after hearing this, what I could say is like Tgrade is building a bridge between traditional finance into the crypto world. But
correct, yeah.
Who is Tgrade really for? Is it just institutions, or like a normal people, like the majority of the viewers will be able to use it too?
So I think it will go through several phases. So at the beginning, we're going to see traditional institutions come and build businesses on blockchain. We already see that. The JP Morgan are hiring, I don't know how many blockchain developers. Their journey is a slightly different one because they start with this whole permission world, and the theory is that one day when they get confident enough, they can go public. But we know that's not really going to work because the permission systems sacrifice security for speed.
Yeah.
And so you can't go public with it because you then open yourself up to all the hackers in the world. So eventually they're going to have to realize that, you need to work on the public systems to begin with. Do it for the security from the ground up, make it safe. So once you have that framework in place, you'll have a mixture of the traditional guys trying out these things. They'll start with small projects, some limited amounts. You'll have some fintechs that want to really start disrupting the market. You have a neobank stepping in saying, hey, this is an easy way to tokenize some deal flow. We'll steal some market share off here and so on. And I think as well, you're hearing the mood music as well, and what the regulators are saying to the DeFi protocols, that we need a bit more structure here. So if you're a DeFi protocol today, I would say build on Tgrade with the regulatory frameworks in place. You don't need to switch them on from day one, but when they do come with a big stick, you turn it on because it's all in place.
You already have them.
Yeah.
That's great. So I see there is a lot of innovation on the development process of Tgrade. There's so many different things that I never heard before in other projects or in other protocols. And I want to touch on proof of engagement a little bit later. But first, so what are the applications that you're expecting to see built on top of Tgrade? It's just like lending protocols, or like, swapping, like a normal protocol that we see already in DeFi?
That's possible. That's one possible way. But I think the real world applications is when we can connect the real world. So one example is a company I'm talking to who's in the film business, and they're looking at a very opaque market in financing, funding, and revenue generating from films, and they want to do all this through smart contracts. So they're actually working together with the university to come up with a really nice library of standard smart contracts. They'll then do that. Why do they need Tgrade? Comes back to that whole compliance thing. They have to make sure that accredited investors can buy this, ordinary investors can invest there, and so on. And they can segregate who's investing in which tranches. And that's why they need one of our blockchain rather than just a general one of Ethereum, Solana, whoever.
Yeah.
So that's why it's important to them. And again, they control that whole setting up of the trusted circle and what goes on in there. So that's one example. Another one we're looking at is sustainable finance. There's a big demand for like green bonds and so on. There's no reason why that can't be put on Tgrade. Yes, there's regulatory hurdles to be had. They can be worked on, but that whole point of raising money, these things are oversubscribed. Whenever someone issues a green bond, people want to buy a part of that, especially, the people in their 30s and 40s, they care. They really care where their money's going. They don't want to put in more oil and more gas and all the things that kill the planet. They want to, these things are oversubscribed. So why does that need blockchain? Again, it comes back to transparency. If you think of a smart contract, it's a series of promises, a workflow, and you do the same for a bond. What are the tranches? What have I achieved on a green point of view, as well as my coupon? And my loan pays back a certain amount. How much electricity did I generate in a wind farm? How much, what was my impact? How do I measure that? Cryptographically signed at each step. That's the kind of thing you do. But you're raising real money for real projects. So it's a step away slightly from that DeFi of bring the wall of money in, lend to each other, leverage up, play a game of last sucker, and then protocol makes money or doesn't.
That's super interesting, because definitely DeFi needs regulation if we want to make this mainstream, if we want to bring like the money that is already in the traditional finance. As you said before, like I remember seeing watching the graph, the charts for DeFi, and it was like $8 million, $20 million. I was just like blown away how fast it was growing. But that's nothing. That's like pocket money for, like, if you compare this to the traditional finance, which like David, there's like quadrillions of dollars in those markets. So if we can bring a portion of that, that'll be amazing for the whole ecosystem.
Yeah, absolutely. Yeah.
Okay. What is the biggest challenge for Tgrade?
The biggest challenge is traditional finance and reluctance to innovate. They're in a nice position. The existing systems work. They make money. They make a lot of money. If you look at bankers' bonuses this year, what have they done? They've gone up a huge amount because of all the activity that's been going on in the corporate world. So they are not going to be fans of something that disrupts their livelihoods. That's going to be a big barrier. Yeah. The other side of it, the asset managers who manage our pensions, our long-term savings in the traditional markets, they're not known for innovation. They're risk averse. Like, why would they go to blockchain? Okay, we could make a bit more money. We could be a bit more transparent. We're making enough money. Why do we care? Where it will come from, like happening in DeFi, so retail will push it and say, look, you guys, when you see, say, the S&P last year went up, I don't know, let's call it, say, 15%. And you look at your portfolio at the end of the year and you go, 6%? What's happened to the other bit? That goes into the broker, the intermediary, this or that, the other. Now, if you bring it more peer-to-peer, then you're starting seeing returns. Then you start voting with your wallet, don't you? Saying, well, I get a better return by investing in this. It's cleaner, it's more peer-to-peer. And I would rather lend direct to the wind farm guy or a couple of those than I would to go through to a broker, to then go to another bank, to go to the market, and to go to the clearinghouse and all the other pieces that goes on. So that's where the difficulty is. It's chicken and egg thing. There's a liquidity traps as well. It's like, how do you suddenly get everyone buying this stuff, and who's going to buy these bonds on the blockchain when normally traditional would just hoover up all the issues? So those will be the challenges, I think. I'm not afraid of them. I'm sure that we'll get through it, but it's maybe not going to be a straight line. It'll be left and right and left and right, and we'll get there in the end.
I mean, the awareness is created already. They've seen DeFi, but they're seeing like the huge growth and the potential that it has
definitely
to become like a huge part of the total economy. So it's going to be challenging, but also it's going to be very rewarding when you guys start getting the first one, because when you get the first one, this can be applied very quick and it's super scalable once you get
Definitely.
the first one.
Yeah.
Cool.
Yeah.
Hey, but also we definitely need to talk about the philosophical part of DeFi, because there's so many people that think, oh no, but if DeFi has anti-money laundering laws, if DeFi has KYC, it's not DeFi anymore. So what do you say to this?
I think with an idealistic hat on, if we were all beautiful people and no one cheated anyone, DeFi is lovely. A global pool of liquidity where everyone has a democratic chance to play like the banks do. They provide liquidity to LPs. They can lend their stuff. They can borrow. It's lovely, right? We know the dark side of it. Nearly 900 million was stolen last year in rug pulls.
Wow. Yeah.
700 million through MEV. That's a tax on transactions. It's not fair. So we know that humans misbehave. It's reality. We have to accept that. So while idealistically, philosophically, yes, we're all one nation, we're all people, there's no discrimination, whatever.
Beautiful.
the minute you anonymize things, then we know what happens on social media. You know, you're just hiding behind a keyboard. We know what happens in crypto. People cheat. And you know, we have to acknowledge that. And you have to acknowledge that either we self-regulate, or the path may be go to regulations to keep, you know, AML, KYC, all that type of thing, which you can argue about. We could have a long discussion about whether that actually means something, whether it's relevant. But it's accepted. This is how we operate. If you want to connect the real world to the crypto world, you have to put that in place. Maybe the path is we do this climb up, we comply, and then we come back down again, become self-regulatory, because our frameworks become stronger than the AML KYC implemented by the current system. We know that 2 trillion a year at least as proceeds of crimes go through the traditional banking system. That's corruption, that's gangsters, that's drug dealing, all that gets washed because there are people in jurisdictions that you know, they'll turn a blind eye. There's money to be made, so they will facilitate it. But
once you get caught in the middle as a middleman, it's not going to happen.
And one of the favorite things I learned last year, a piece of information I love telling people, is the first rules about anti-market manipulation was in Amsterdam in the early 1600s. A couple of guys got together to try and short sell, and the exchange said, no, we're not having that. And they banned short selling because they were colluding. And so they had to put some legislation in there. And 400 years later, we're still legislating to try and stop or tone the bad behavior. You know, and you think about the guys who did the LIBOR scandal. I mean, they were getting bonus a couple of $100,000. They were junior guys. The cost to everyone was billions. In the effect of what they did. You know, it cost us all in our mortgages, our loans, everything, because they were playing with LIBOR, which is a very, very important thing that they manipulated. And we can't have that. You know, it's an opportunity to take a pragmatic view, like how do we stop some of this stuff? And I'm not saying that, you know, we need regulations and rules everywhere, but let's have sensible ones that achieve some of these aims to protect the consumer. That's very important.
Don't go to the other side, which is like over-regulated everything, so people like can't do anything in DeFi because it's not for the small or for the little guy. It's just for the big banks and corporations. So there's a really important balance that we have to have right here.
And I think if we as an industry in the emerging DeFi industry can accept the fact that we need rules, why do we help shape them? Why do we proactively say, look, we're doing this to get our house in order. This is how we're going to do the stopping of this, that, and the other, all the bad things going on, by creating our own rules because we understand the technology better. Rather than saying, no, we're not going to obey rules. And then they say, well, you have to do it our way because you're not suggesting anything on the other side. So I think proactive cooperation is something we need.
There is always that fight between, you know, crypto people, crypto native people, against just the traditional finance people. It is, and it's going to be really interesting to see that merging, because it has to happen somehow.
Yeah, definitely.
Okay. Now we have seen like many concepts. We have trusted circles, which is basically a group of people that create their own laws to be compliant with their governance laws. And we also have something I don't think you have mentioned this, like is Oversight Community, which is the part of like what I saw is like a governance pretty much for the trusted circles. No, for the trusted circle. For the
running of the
proof
chain.
of engagement. Perfect. So can you please break down that concept of Oversight Community and proof of engagement from a standpoint of a normal user and for the consensus mechanism?
So the idea of the normal user is we have a lovely secure platform, and we achieve that through proof of engagement. The fundamental philosophy of proof of engagement is that we took the view that the strongest blockchain or the most secure blockchain has the strongest community around them. And to get the strongest community around it, we thought, well, how do we align the incentives of everyone? And we're not just talking about core devs and the validators. That's a subset of a community around a blockchain. We need people who man the community channels, who do the documentation, who do the outreach, who do all the tools around that makes the blockchain useful. That's the whole community that needs rewarding. And it's not through, we've seen them in crypto where you have elaborate community funds and people begging, saying, well, can I have that? And you get the keyboard warriors saying, no, I can find a man who'll do the whole thing for $5. And he's like, come on, And it's not very democratic. A lot of shouting goes on. There's a bit of apathetic voting, and it scrapes through normally. And that's how projects get funded. Now we said, well, how about if we create this whole mechanism around incentivizing the whole community? So this is where the engagement idea was born. We then looked at proof of stake as well and said, well, what are the shortcomings of proof of stake? Proof of stake's great. It solves many problems. It makes a chain more responsive. It secures the network by scarcity of tokens. We all understand that. Yeah. In practice, what we see is concentration of power. Yeah. A lot of grumbling. When Binance collects all its stakers together and puts one account there and doesn't really get involved in the network. I'm not singling out Binance, but I'm just saying that's one of one of the whales that turns up and validates or does staking in a staking way. So we see this concentration of power, and that's not healthy. We really want to keep it decentralized as possible. So we said, well, in a consensus mechanism, how about if we sort of did a combination of authority and stake together? Now, the authority comes from the engagement points. So the more active a validator is, they accrue engagement points, and you combine that with stake, and that gives you the voting authority. So that allows smaller validators to come in with a smaller stake, be very active, be very engaged, and they match the power of somebody who's just ticking along, maybe does a bit of support, and they have an equal voting power. Then it becomes a bit more equal. Then you have more decentralization that way. We've also got deep in the model as what's a sigmoid curve. So basically a curve that goes up and flattens off. And that's our anti-whale protection. So if somebody came in with a great idea, they were just going to dump a whole load of tokens and say, right, I'm staking now. I want to dominate and get all the rewards. After a certain point, you get no more rewards. There's no incentive for you to do that. So everyone says, okay, I can just spin 5 validators up, can't I? And the answer to that is you could, but you have to identify yourself to get engagement points. So if you had 5 anonymous wallets and they all belong to you, you have to own up to one of them to get engagement points, which you can, but the other 4 get none. So in the authority balance and the stake balance, they would be lower because they had less engagement points. In fact, they'd have none because they wouldn't really be able to earn them with the same person. We'd say to one owner, you have engagement points for things you do. You can't split that amongst 5 validators. So then again, we try and make the system fair that way. So the whole engagement point concept needed somebody to be able to give out these engagement points. And this came back to looking at how DAOs worked, at Cody's law being too brittle. The minute you put up, say, even if you have 150 criteria, you'll find somebody will find an edge case to game it. If it's all fully automated, you read the rules and you do simulations, and you can run models on it and say, this is the way to maximize my return by doing these and these and these activities, if it's all coded. By having a human element, we needed a committee of people to do that. So we created the Oversight Community. What they do, it's a self-sovereign group. You can get voted on, voted off. It can be as large as it needs to be. And when you join as an Oversight Community member, you pay escrow. So we have some mechanism to punish you. So if you're a bit slack, a bit sloppy at giving out, finding out who somebody really is, and you do it a couple of times, the rest of the community can turn around and say, look, Martin, you're doing a bit of a sloppy job. We're going to take some tokens off you. The minute you get some of your escrow taken away, you lose your voting power. You need to pay some back in to become active again. So it's a small punishment. The big one is if Martin tries to collude with a load of his friends, saying, look, I'll give you some engagement points, you give me 20%. I get caught, bang, out I go, no more tokens. I've lost my escrow. Banned, can't get involved anymore. So we need that mechanism in there, and that keeps it self-sovereign. And so this community then oversees and has a dialogue with the community on what's an engagement point, what are we wanting to reward as a community as a whole, and tie it all together. Okay. And that's how it works.
Very interesting. There is so much innovation in this concept. Of course, I talked to the Nacimiento crypto community last night, and I told them, hey, I'm going to talk to Martin from Tgrade. They already know the project because they watched the video before with Ethan. And they say, I say, do you have any question for him? And they were always like, Wen Mainnet, when talking, when pre-sale for Nacimiento crypto. So if you want to answer one of these questions, go ahead.
So, yeah, I mean, we're very close to mainnet launch. We've always said it's Q1 this year, where we've had this testnet running. We're completely overwhelmed by the response. We had 300 validators show up. We weren't expecting 3 or 4, but that's how it works. So the next stage we're doing, we're really refining the backlog, the last few technical things that need doing, some of the things that, you kind of forget in a project, you put to one side. It's pulling down the last few pieces, and this is the stage we're at in the development side of things. Then when we have that done, we'll announce the dry run testnet. So this is where we get all the validators who signed up to Genesis set. There's 70 of them. We know who they all are. We've met them, talked to them, signed them up. And these are the guys we hope will help start the next testnet. We'll start one with all the validators as a test to mainnet launch. Then we do a short test net, run things through, make sure everything's working, everyone's happy. We try some engagement cycles. Then I would think we shut down the test net for 2 weeks while we sort out any last minute bugs, any tweaks. We're bound to find something. Then we go to mainnet. So I think realistically we're weeks away.
Oh, very nice.
Certainly this quarter we're definitely on target. We'll meet that deadline. So
awesome.
It may end up being mid-March, who knows, but it's I will not I won't tell any dates because I don't want to stress anyone.
So to wrap up this conversation, is there anything important that you think is important to say that we didn't touch on?
I think what's really important to say is that it's coming soon. If you've got business ideas that needs some kind of pools of people setting up, some communities, it doesn't have to be high finance. It can just be a group of people together who want to do some OTC trading, or to create a digital asset on a chain, but have it controlled within a community. Doesn't matter, it can be very, very local, it can be very very national. It's all different sizes. But start thinking in that mindset of what you can do, because once you have the trusted circle, you can issue a digital asset, permission a smart contract to work in there, and you can start really building businesses quickly that way. And that it's all secured on this very, very strong proof of engagement chain that we have a whole community running around, making sure everyone's talking, contributing, innovating, making sure this chain's secure. So that's the main message.
Plus IBC, you guys are adopting IBC. You're going to be also connecting with the whole Cosmos ecosystem.
Absolutely. Yeah.
Awesome. Okay.
Yeah.
I think
Exciting times.
Yeah, very exciting. Yeah, I'm definitely very excited about this project. I want to see it. I want to see how it merge, how it brings these two sides of the world together and merge them.
Yeah, I think this time next year we'll have a very different conversation. We'll be looking back and going, wow, this is what's happened.
Wow,
it's not
so
what we
fast.
expected.
Yeah. Okay.
That would be nice.
Martin, thank you so much for being here. Thank you so much for your time and coming here and explaining us a little bit more about proof of engagement, which is a really important concept. And I think many different blockchains should apply this to their own consensus mechanism. Yeah.
Fantastic.
Thank you.
Okay. Thank you very much.